Does a trust get a step up in basis? Have you ever wondered how trusts impact the tax situation for inherited assets? Today, we will clarify whether a trust gets a step up in basis, an important concept in estate planning. A step up in basis is a tax adjustment that resets the cost basis of an inherited asset to its fair market value at the time of the original owner's death. This adjustment can help reduce capital gains taxes for beneficiaries when they sell the inherited asset. Let's start with revocable trusts. These trusts are considered part of the grantor's estate for tax purposes. When the grantor passes away, the assets in a revocable trust typically receive a step-up in basis. This means that beneficiaries inherit the assets with their cost basis adjusted to the market value at the time of death. This adjustment can significantly minimize capital gains tax when the beneficiaries decide to sell those assets later. Now, let's talk about irrevocable trusts. These trusts are treated differently. Since assets in irrevocable trusts are often not included in the grantor's taxable estate, they generally do not qualify for a step-up in basis. This means that beneficiaries might inherit assets with the original cost basis. When they sell those assets, they could face higher capital gains taxes. In 2023, the Internal Revenue Service issued a ruling that clarified this situation for irrevocable trusts. For assets held in these trusts to receive a step-up in basis, those assets must be included in the grantor's taxable estate at death. Many irrevocable trusts are set up to exclude assets from the grantor's estate, which means those assets may not get a step-up in basis. This change can increase the tax burden on beneficiaries. When planning your estate, using revocable trusts remains a common strategy to ensure assets receive a step-up in basis. This approach helps preserve tax efficiency for beneficiaries. If you are considering irrevocable trusts, it is essential to understand that the step-up in basis may not apply unless the trust assets are included in the grantor's estate. This can significantly affect the overall tax outcome for your heirs. Estate planners and elder law attorneys often recommend reviewing trust structures regularly. This is especially important given the changing rules from the Internal Revenue Service. By optimizing the tax benefits of your trusts, you can align them with your goals and those of your beneficiaries. For assets expected to appreciate significantly, passing them through vehicles eligible for a step-up in basis, like revocable trusts or direct inheritance, can help reduce capital gains taxes for heirs. So, to answer the question, yes, a trust can receive a step-up in basis, but it depends on the type of trust and whether the assets are included in the grantor's taxable estate. Revocable trusts generally qualify for a step-up in basis, while irrevocable trusts often do not, especially following recent clarifications from the Internal Revenue Service.